The rich use these 5 loopholes to pay less taxes. Most of us are not aware of them. Number 4 is crazy. Number 5, installment sales. Imagine you've just made $1 million in the stock market and you want to buy a new house for $2 million. You can't afford the down payment, but luckily you found an installment sales contract where you only need to put 10% down and the rest will be paid over the next 30 years. This way, you don't have to pay any taxes on the profit from the stocks yet because you haven't technically sold them. And also, you don't have to worry about paying capital gains tax or income tax on the transaction. You simply report the interest you pay each year on your tax return and deduct it from your taxable income. The installment sale loophole lets you defer taxes indefinitely until you sell the property. But this can take decades, and by then you might be in a lower tax bracket, so you won't have to pay as much. No for like-kind exchanges. Let us say you own a piece of land worth $1 million that you bought for $500,000. If you were to sell it, you would have to pay capital gains tax on the $500,000 profit. But what if instead of cash, you could trade this land for a brand new apartment building valued at $1 million? This way, you wouldn't have to pay any tax on the transaction. This loophole is called a like-kind exchange. It allows you to trade one asset for another and defer taxes. Imagine if you could repeat this process over and over again, trading up to properties worth tens of millions of dollars without ever having to pay tax. That's exactly what happened with Ryan Serhant from $1 Million Listing New York. He took advantage of this loophole to build a real estate empire worth over $60 million in just a few years. When asked how he did it, he said, "Every single thing I've ever purchased, I've done a 1031 exchange on." A 1031 exchange is a type of like-kind exchange. It was created by Congress in 1921 to encourage people to invest in real estate. It says if you reinvest all the money you make into more real estate, you won't have to pay any tax. So investors often use this loophole to upgrade their properties. For example, they might trade a small house for a bigger one or trade an old office building for a new skyscraper. Note 3. Installment notes. When you lend money to someone, you're helping them start a business or buy a house. They'll probably charge you interest, but you can also ask them to split the interest payments throughout the year rather than all at once. If they agree, you'll receive regular checks in the mail every month. These are called installment notes. As the lender, you don't have to worry about taxes on the interest until you actually receive it. So if you know, you'll be in a lower tax bracket next year. You can use this time to your advantage and defer paying taxes. Or if you're in a higher tax bracket, you can use the installment note loophole to spread out the taxable interest payments over several years. Number 2, retirement accounts. When we retire, we usually take out a loan against our future selves. We borrow money from our retirement accounts, like a 401k or IRA, and pay it back with interest. This way, we don't have to pay taxes on the loan, which is great if you need extra cash flow during retirement. But you must be careful because if you don't plan properly, this loophole can cost you thousands in penalties. So make sure to do your math before borrowing from your future self. Number 1, home equity loans. If you have a lot of equity in your home, meaning you've paid off a large portion of your mortgage, you can borrow against that equity using a home equity loan. It's essentially a second mortgage on your house once you have the cash in hand. You can buy anything you want, such as a vacation home, rental property, or even stocks. Since the IRS considers your home equity loan to be a non-taxable loan, it doesn't count against you when calculating your taxable income. So what does that mean? Well, let us say you have $500,000 of equity in your home and you decide to borrow $250,000 using a home equity loan. You've now watched 3.5 of the most popular videos about the rich and taxes. Here's a summary of the top 3 biggest takeaways. Number 3, the rich use installment sales to defer paying taxes indefinitely. They buy expensive assets like houses and artwork using installment sales contracts where they don't have to pay the full fee. Rise up front instead. They make small down payments and pay the rest over several years or decades. This way, they avoid paying capital gains tax or income tax on the transaction. But you need to be careful because if you enter into an installment sales contract for something that loses value over time, like a car or artwork, you could end up owing more money in taxes than you would have if you had simply sold it outright. Number 2, the rich use like-kind exchanges to trade up to more valuable assets without paying taxes. They use Section 1031 of the Internal Revenue Code to trade one asset for another and defer taxes. For example, they might trade a small house for a bigger one or an old building for a new luxury condo. This way, they can acquire more expensive assets without paying any taxes on the transaction. However, you need to make sure that both properties are considered like-kind by the IRS. They must be used for similar purposes and have similar characteristics. For example, you can't trade a vacation home for a commercial office building because they may not consider like-kind. Number 1, the rich use installment notes to collect interest payments over time without paying taxes. When they lend money to someone, they often ask for regular installment payments that include a portion of the interest. For example, instead of receiving one large check for $100,000, they'll ask for 12 checks totaling $8,000 per month. This way, they receive a steady stream of income and don't have to pay taxes on it until they actually receive the money. However, you need to be careful because the borrower might default on the loan and not make the installment payments. If you found these tips helpful, don't forget to comment, like, and subscribe for more videos about the rich and taxes.